Today, Mirage versus Reality, the DFA daily to the 15th of January. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. Now, you may remember that a few days ago I summarised the gross loan balances in banks and non-banks across Australia. And the fact is they'd gone up just a little over the last month or two. But today we got the data from the Australian Bureau of Statistics for new lending back in November. And given the fact that new lending was pretty much at an all-time high, we can read into that there are also a lot of people who have been paying down their loans. But let's now look at what the ABS said with regard to the total value of new loan commitments for housing and the value of owner-occupied home loan commitments, because they both reached record highs in November, according to the ABS. And here, let me just underscore again that commitments are essentially a promise to lend by a lender. It doesn't mean necessarily that the loan is drawn down. The statistics on loans actually drawn is rather different from the commitments made. Now, that might just be a timing difference, or it might be that people are actually getting commitments before they have a particular transaction in mind. The total value of new loan commitments for housing rose 5.6% to $24 billion in November. That's seasonally adjusted. And that's a 23.7% increase on November 2019. The value of new owner-occupied home loan commitments rose 5.5% to $18.3 billion in November 2020, and that's 31.4% higher than November 2019. And loan commitments for existing dwellings rose 5.9%, and that was the largest contributor to the rise in November's owner-occupier loan commitments. But the value of construction loan commitments also grew by 5.6% in November, rising, wait for it, 75% since July. And this, of course, follows the implementation in June of the government's home builder grant in response to COVID-19. Other federal and state government incentives and ongoing low interest rates also contributed to the continuing growth in new housing loan commitments. In November, the number of owner-occupier first home buyer loan commitments rose 3.1% to reach 13,905 seasonally adjusted, and that's a 42.5% rise since the start of the year. That's the highest level seen since October 2009, when similar rapid growth was spurred on by the temporary tripling of the first home owner grant, which was part of the government's economic stimulus package in response to the global financial crisis. Owner-occupier first home buyer loan commitments accounted for 35.1% of all owner-occupied commitments, that is excluding refinancing. And in original terms, the number of first home buyer loan commitments for investment purposes accounted for 0.1% of all first home buyer commitments. And the value of owner-occupier loan commitments rose across the largest states and territories, but showed much more mixed results in the smaller ones. Victorian owner-occupier home loan commitments rose sharply, up 19.6% in seasonally adjusted terms in November, reflecting a surge in housing market activity as COVID-19 restrictions were eased. And the total value of loan commitments for investor housing rose 6% to reach $5.6 billion, and the value of new loan commitments for fixed-term personal finance rose 13.2% in November, seasonally adjusted, which was mostly due to increased commitments for vehicles. Now, of course, the Housing Industry Association went to town on these numbers, saying the number of loans for the construction of a new dwelling rose for the 6th consecutive month in November to reach a new record. This is the highest result for the second month in a row since the ABS began reporting this data back in 2002. While Home Builder was the catalyst for improving consumer confidence in the housing market, the strength of housing finance data is also due to several factors, including low interest rates, they said. The number of construction loans to owner-occupiers in the 3 months to November was 83.7% higher than the same time last year. And the number of loans for the purchase of land in the 3 months to November 2020 was also up by 99.2% compared to the same period in 2019. And they said the HIA new home sales data suggests that detached housing finance approvals will continue to be strong over the coming months. The extension of Home Builder at the end of November is not a factor in this month's results, but it will see the strength in housing finance data extended into 2021. Investors, they said, are returning to the market, with the value of lending to investors up 3.7% for the 3 months to November 2020, compared to the same time last year. And this was driven by loans for the purchase of existing dwellings. And it was also another very strong month for first home buyers. The number of loans to first home buyers reached the highest number since 2009 and accounted for 42% of the total number of owner-occupied loans issued in November. It's evident in today's data that Home Builder has been successful in boosting confidence in the market and creating work on the ground, HIA said. Across the states, the number of loans to owner-occupiers for the construction of a new dwelling in the 3 months to November 2020, compared with the same time last year, increased the most in Western Australia, up 144%, followed by Queensland, up 128%, and the Northern Territory, up 127.6%. Victoria was 71.2%, South Australia 53.1%, Tasmania 45.8%, and New South Wales just a mere 43.2%. The Australian Capital Territory recorded an increase of just 28.9% during this period. So, well done, folks. We are dancing to the official tune. Borrow more and buy more property. Never mind about the current sky-high housing debt and the pressure on many households. Just keep on pumping the housing Ponzi scheme. But of course, as I keep underscoring, that may work for a little while, but it's not a long-term economic solution to the broader issues that are facing Australia. So it is a mirage, but it is a mirage with considerable potency from many people, and that's one of the reasons why my modelling continues to suggest a stronger performance for house prices in Australia than previously expected. But standing back more broadly, think about what's happening in the US, because of course the US and its economy is quite critical to the forward trajectory of the global economy. And they reported that 9 million more Americans are out of work than before the pandemic struck. And the virus, of course, continues to rage across the US. Governor Powell and his Fed colleagues are committed to using, quote, all of their tools to support the recovery. And the last month signalled interest rates will stay near zero, at least as far as 2023. But now, President-elect Joe Biden will ask Congress for an additional $1.9 trillion to fund immediate relief for the pandemic-wrecked US economy. A package that risks swift Republican opposition over big-ticket spending on Democratic priorities, including aid to states and local governments. as reported by Bloomberg. The proposal was unveiled on Thursday, and it will be followed up in coming weeks by a second broader jobs and economic recovery plan that will include money for longer-term development goals such as infrastructure and climate change, according to a senior Biden administration official. The pandemic aid bill, spanning $400 billion for COVID-19 management, more than $1 trillion in direct relief spending, and $440 billion for communities and businesses, comes in at more than double the bipartisan bill approved last month and only slightly below the March 2020 CARES Act. The bigger size and the inclusion of democratic priorities, such as a minimum wage hike, does set a challenge for Biden to bring Republicans on board. Some measures, including aid to states and money for health care, are likely to need 60 votes in the Senate, which will have a 50-50 bipartisan split, with Vice President Kamala Harris' vote conferring control to Democrats. Jobless benefits and state aid, along with the minimum wage, could go through with a simple majority under a special rule. The risk of doing too little is far greater than going too big, a Biden official said. The incoming president last week highlighted that historically low interest rates offer space for the US to use deficit spending to strengthen the economy now. President-elect Biden's $1.9 trillion American Rescue Plan is ambitious but achievable and will rescue the American economy and start beating the virus, the Biden transition team said in a statement. And US stocks climbed to record highs this month on expectations of another major stimulus bill in the wake of Georgia runoff elections that gave the Democrats state control. Speculation the package would prove bigger than the economists initially forecast have also boosted Treasury yields, but stocks dipped at the close on Thursday as news of the package came out, while Treasuries remained lower. House Speaker Nancy Pelosi and incoming Senate Majority Leader Chuck Schumer applauded Biden's plan in a statement on Thursday, and they pledged to work quickly to put Biden's vision into legislation that will pass both chambers and be signed into law. And they also said they hoped for GOP support. While the Biden team had telegraphed in recent days it wanted to forego using so-called reconciliation, the budget maneuver that allows a party to pass a bill with a simple majority of votes in the Senate rather than the normal 60 needed to cut off debate and move to a vote. The bigger size might make it harder. Some aspects of the proposal, like stimulus checks, expanded unemployment benefits and the minimum wage increase, can be done under the special budget tool, while most experts say others like health, education and local government aid won't qualify for a simple majority vote. And the rescue plan includes $350 billion for state and local governments, more than double the $160 billion that a number of GOP members had backed late last year in a bipartisan compromise proposal. That's still less than nearly $500 billion that Pelosi and fellow Democrats had in their plan. Biden officials said on Thursday that the stimulus plan reflects input from members of Congress, as well as from governors and mayors that his team consulted in the past week. Among the elements in the Biden proposal are direct payments of $1,400 on top of the $600 approved in December, $400 per week in supplementary unemployment benefits through September, $350 billion for state and local governments, raising the minimum wage to $15 an hour, $130 billion to help schools reopen, $160 billion in funding for a national program for vaccination testing and other coronavirus containment efforts, $30 billion for rental and small landlord support, $25 billion for childcare providers, expanded food assistance, expanded child tax credits, expanded medical and family leave. The sense of urgency about further economic support was showcased on Thursday with a report showing that weekly jobless claims surged the most since last March. Some 965,000 Americans filed for state benefits, a figure far exceeding the worst days of the 2007 to 2009 recession. Applications for US state unemployment benefits surged last week by the most since late March, pointing to persistent labour market pain as coronavirus infections continue to soar and potentially adding to momentum for a larger federal stimulus plan. Initial jobless claims in regular state programs rose by 181,000 to 965,000 in the week ended the 9th of January, according to Labour Department data that showed a broad number of states with large increases. On an unadjusted basis, the figure jumped to 1.5 million. The scope of the increase caught many economists by surprise. Most of the several dozen surveyed by Bloomberg projected the claims number would be little changed, and not a single one of them had predicted so big a jump. The median forecast in a Bloomberg survey of economists called for 789,000 initial claims. And the S&P 500 advanced in early trading, along with the yield on the 10-year Treasury on prospects for more COVID-19 relief. Continuing claims in state programs, an approximation of the number of people receiving ongoing benefits, climbed by 199,000 to 5.27 million in the week ended January the 2nd. The restrictions imposed to combat the third COVID wave clearly has done great damage, but it's not obvious that the incremental hit is still increasing. Ian Shepherdson, chief economist at Pantheon Microeconomics, said in the note, claims will drift sideways more or less over the next 2 to 3 months before restrictions on the services sector can be gradually eased as vaccinations bring herd immunity into sight. Jobless claims have exceeded 750,000 each week since virus cases started surging again late last year, underscoring the impact of infection fears and business restrictions on employment. Vaccine distribution should help restore economic activity in the coming months, but the first quarter could continue to bring labour market weakness until inoculations reach a critical mass. The recently approved $900 billion of pandemic aid should provide some relief for workers and businesses in the current quarter. Enhanced unemployment benefits passed in the December bill, combined with the $300 weekly top-up for regular state benefits, may have contributed to the latest increase in claims, said Gregory Dacko, chief US economist at Oxford Economics. From a signalling perspective, once you see that maybe you think it's worth me filing because I can get an additional X dollars per week, that's a positive effect in terms of signalling, but I would say it's not a revelation of additional laziness, he said. The initial filings far exceeded the worst days of the 2007-09 recession and may skew negotiators towards a bigger relief package. Among states, Illinois and Florida reported initial claims exceeding 50,000 last week, while California and Kansas topped 20,000 on an unadjusted basis. Pandemic unemployment assistance, a program for self-employed and gig workers, saw 284,470 initial claims last week on an unadjusted basis, an increase of more than 123,000 from the prior week. And in the week ended December 26th, there were 4.17 million continuing claims for pandemic emergency unemployment compensation, which provides extended jobless benefits for those who have exhausted their regular state benefits. Sinking incomes and continued damage to the labour market, coupled with the ongoing spread of the virus and the slow pace of vaccinations, adds to the long list of crises the incoming administration will inherit when Biden takes office on January the 20th. And congressional lawmakers also must contend with a second impeachment trial for President Donald J. Trump, which will eat up the attention and time of senators as Biden seeks to pass his first major legislative package. In fact, many Democrat operatives and lawyers have spent the past week building support and charting out a strategy for impeachment instead of focusing solely on the billions of dollars at stake with this COVID-19 package. Democrats say they want to try to pass a package by mid-March when the special unemployment benefits expire, and that Biden's plans will reflect the urgency of the economic situation that the US faces and the need for urgent action. Biden's National Economic Council Director, Brian Deese, said in an interview, "We need to focus on unity, even in a moment that is challenging and as difficult as this one." And Federal Reserve Chair Jerome Powell sought to stamp out talk of a premature reduction in a central bank's massive bond-buying campaign, saying, "Now is not the time to hold that discussion. We know we need to be very careful in communicating about asset purchases," he said on Thursday during a virtual discussion. "Now is not the time to be talking about exit. I think that is another lesson of the global financial crisis. It is to be careful not to exit too early." Some of his Fed colleagues have given investors a nervous reminder of the 2013 taper tantrum by publicly debating if a strong economic recovery from the pandemic might warrant dialing back the buying later this year. Together with the outlook for more aid from Democrats, who won control of Congress, of course, that's helped push longer yields higher. But Powell said the economy is, quote, "far from our goals," and noted that the lessons of 7 years ago, when markets were rolled and yields shot up, when investors were surprised by news the Fed was thinking of paring back its bond buying, put officials on notice that they should choose their words with care. Powell sure did not sound to be in a hurry to taper, said Roberto Perry, partner at Cornerstone Macro LLC in Washington and a former Fed economist. The wiser thing to do is not to put a timeline on tapering, at least at this stage. The Federal Open Market Committee last month pledged to continue to make $120 billion in monthly purchases of treasuries and mortgage-backed securities until there's, quote, "substantial further progress toward employment and inflation goals." The vagueness of the guidance has led to differing interpretations among policymakers and investors, with at least 4 Fed presidents having said that a strong economy could prompt discussions of tapering of bonds later this year. But other Fed officials have pushed back. Fed Vice Chair Richard Clarida said last week he didn't forecast adjusting the buying this year, and Governor Lyle Brainard on Wednesday called the pace appropriate for quite some time. And Powell pointedly said that the guidance was deliberately not based on any date in the calendar when the Fed would think about paring back asset purchases aimed at holding down longer-term borrowing costs. But he did promise that there would be ample warning if conditions were getting ripe to consider such a step. "We'll let the world know," he said. "We'll communicate very clearly to the public, and we'll do so, by the way, well in advance of active consideration of beginning a gradual taper of asset purchases." Powell's comments weighed on front-end US rates but boosted long-end yields, further steepening the yield curve. The Eurodollar futures for 2024, used to wager on where the Fed's target rate will be, were supported while inflation expectations as measured by the so-called Treasury break-even rates climbed and the 10-year yield reached 1.13%. Stocks fell for the first time in 3 days and the dollar largely maintained its decline for the day. While the Fed chair said he was optimistic about the US economy over the next couple of years, he also spelled out that it had to weather a tough winter. He reinforced that message on Thursday, noting that the time to raise rates was no time soon. After years of too low inflation, the central bank approved new policy guidance in September, spelling out it would be appropriate to keep rates near zero until inflation has risen to its 2% target and was on track to moderately exceed that level and hold off prematurely a tightening policy even as unemployment declines to low levels. That wouldn't be a reason to raise interest rates unless we see troubling inflation or other imbalances that could threaten achievement of our mandate, Powell said. That is a significant change. Now, the 2 quick points. The first is that the 10-year yield curve is definitely higher, and that, of course, is potentially signalling higher rates ahead. And the markets have therefore started to consider the prospect that rates may rise sooner rather than later. And the second point is that the Fed is jawboning like mad because, frankly, there's not much else it can do. Sure, it can go on printing more money, but all the evidence suggests that money printing is not actually converting through into the real economy, nor indeed doing what it was required to do. And so it's been following that same track for a long, long time. And why would things change now? And it's worth reflecting on this, that 20% of all US dollars in circulation came into circulation within the last few months, thanks to the QE printing. And yet, inflation is hardly stirring. Sure, the UN reported this week that food costs were on the rise, but overall inflation is still very benign, and in fact, as I've argued before, we are in a strongly deflationary environment, even with the proposed Biden stimulus. So all of this shows me that the Mirage may sound reasonable, that the virus will get under control, the economy will reopen, and everything will be wonderful. The reality is much more complex. We think that the virus will continue to wreak havoc for a lot longer. And the deflationary effect of all the money printing and the very low rates will ultimately create problems for the broader markets. And that's why I still have the view that the financial markets are overpriced, dramatically overpriced in fact, and that we are in for a correction at some point. It's just the timing of that correction is completely unknowable at the moment. And given what Biden has announced, there is probably at least 1 or 2 more legs up before truth dawns. So we're in this weird situation between mirage and reality, both locally in Australia and globally with the US economy. And all of this tells me that nothing is going to be fixed soon. We're in for a long, slow haul, and I still expect many more wobbles, corrections, spikes, and falls in the markets ahead. And that's true not only of the financial markets, but even of property here in Australia. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.